Today, we're going to cut through all that noise. I want to give you a really clear picture of what's going on, why it actually matters to you, and what you should be keeping an eye on for February.
All right, so before we can even think about looking ahead, we've got to know where we're starting from. So the big question is, how did the market actually do in January? Let's dive right into the numbers. So, looking at the numbers, January was, well, it was a bit of a mixed bag. You can see the S&P 500 and the Dow, they eked out some small gains. But look at the NASDAQ, that's the one with all the big tech stocks, that actually slipped a little. What does that tell us? It kind of hints that investors are feeling a bit cautious. Maybe they're leaning towards more stable, established companies instead of those high-flying tech stocks, at least for now. It definitely sets a more careful, kind of watchful tone as we head into February.
Okay, so that's the what. We know the numbers. But the real question, the interesting part, is why. What are the huge forces out there pushing and pulling on these numbers? Seriously, if you can get a handle on these drivers, it's the absolute key to making sense of all the crazy headlines you see every day.
I mean, seriously, you can't turn on the financial news for even 5 minutes without hearing about the Fed, right? It sounds super complex, I know, but its influence on the market is, well, it's massive. And once you break it down, it's actually pretty straightforward. So let's get into it. Why is everyone so obsessed with the Fed right now?
Believe it or not, it all boils down to just one number, the Fed funds rate. The easiest way to think about it, it's like the wholesale price of money. So when the Fed tweaks that single rate, it's like they're adjusting the thermostat for the entire US economy. And that one little change, it creates this huge ripple effect that touches everything. Your credit card interest, business loans, mortgages, you name it.
And that brings us right to where we are today. The stock market has basically turned into this high-stakes guessing game. Everybody's trying to get inside the Fed's head and predict their next move. Are they going to cut rates to get the economy moving? Are they going to hold steady to keep inflation down? Every single piece of economic data that comes out now gets seen through that one lens. And that's why you see stocks swinging like crazy with every new report.
Now, the Fed might set the weather, so to speak, but it's the actual companies that are the players on the field. They're what ultimately drive the market, and the way we see how they're really doing is through their earnings reports. We're just finishing up with the reports from the end of last year, and you could think of these as the market's big report card. Are companies growing? Are they actually making money? See, really strong earnings can lift the whole market, even when everyone's worried about what the Fed is going to do.
Okay, so the other big character in this whole drama is, of course, inflation. You hear about the CPI, that's just how we measure it. All it really means is the speed at which your dollar buys less stuff. And when inflation is high, it's a double whammy. It eats away at company profits and it hurts our wallets. And that is exactly why getting inflation under control is the Fed's #1 job right now. So if we zoom in from those huge economic forces, there are some really interesting smaller trends playing out. You've got the AI boom, which is still shuffling the deck inside the tech world. Then, because of everything going on globally, energy and defense stocks are getting a lot of attention. And all of this is happening while bond yields are moving around, making investors constantly ask themselves, okay, do I go for the safety of bonds or the potential growth of stocks?
Okay, so how is all of this actually going to play out this month? Let's pull up the calendar for February. Seriously, just knowing when this key information comes out can help you understand why the market might suddenly go nuts on a random Tuesday. All right, here are the dates you're going to want to circle on your calendar. Early in the month, we get the jobs report. Now, you'd think a strong report is good, but it could actually spook the market into thinking the economy's running too hot, which would make the Fed hesitant to cut rates. Then, mid-February is going to be huge. We get the latest inflation numbers, and we hear from giants like Apple and Microsoft. Then, toward the end of the month, we get the minutes from the Fed's last meeting, which is like getting a peek at their notes. It gives us clues about what they're really thinking.
Okay, I know. That is a lot to process. It's easy to feel overwhelmed. So the question is, if you're a beginner, what are you supposed to do with all this information? Let's talk about a game plan.
I love this quote from Warren Buffett because it just nails the right mindset. The stock market is a device for transferring money from the impatient to the patient. The goal isn't to jump on every single headline. It's about having a plan and, more importantly, having the patience to actually stick with it. You've got to remember, real wealth, that's built over years, not over a few crazy days in the market.
So what does one of these patient plans actually look like in practice? Well, for a lot of people, the answer is a strategy called dollar cost averaging, and it is beautifully simple. You just invest a fixed amount of money, let's say $100, on a regular schedule, like the first of every month.
That's it. See, when the market is down, your $100 buys more shares. When the market's up, it buys fewer. Over time, this totally smooths out your average cost and helps you completely sidestep that impossible, stressful game of trying to guess the market's tops and bottoms.
When you boil it all down, there are really two kinds of investors. You've got the chasing headlines investor. They're glued to the news, they make emotional decisions, they buy high, sell low. It's a recipe for stress and, frankly, for losing money. Then you have the focusing on a plan investor. They stick to their strategy, they invest consistently, and they keep their eyes on their long-term goals. At the end of the day, you get to choose which one of those you want to be.
Now, let me be super clear. This does not mean you should panic and sell everything or rush out and buy a bunch of stuff based on what happens in February. Not at all. Instead, just use this as a reminder to check in with your own plan. Just ask yourself, are my investments still lined up with what I'm trying to achieve? For example, maybe your tech stocks have done so well that they've become a much bigger piece of your portfolio than you planned. That means you might be taking on more risk than you're comfortable with. So now could be a great time to just rebalance a little bit, get things back on track.
And that really leaves us with the big question for the month ahead, doesn't it? We know the inflation data is coming. We know the Fed is being watched. And we know for sure the market is going to react. But the real question isn't what the market will do, it's about you. Will February be a month that tests your discipline, or will it be a month that rewards it? The market's going to do its thing. The only thing you can control is